Hello everybody. This time we are talking about a rate of return. A rate of return is the gain or lose of an investment over a certain period of time. In other words, the rate of return is the gain or lose compared to the cost of an initial investment, typically expressed in the form of a percentages. When the rate of return is positive, it is considered a gain, and when the rate of return is negative, it reflects a loss on the investments. And then we move to benefits of calculating the rate of return. The benefit of calculating the rate of returns include the first, comparability. Rate of return allows for easy comparison of different investments, making it easier to determine which investments are performing better. And then second, portfolio optimization. Calculating the rate of return for each investment in a portfolio helps optimize the portfolio by identifying underperforming investments and making adjustments to improve overall performance. And then third, performance evaluation. Rate of return helps evaluate the performance of an investment over time, enabling investors to track changes in the investment's value and make adjustments as needed. And then fourth, risk assessment. By calculating the rate of return, investors can assess the risk associated with an investment and make informed decisions about their portfolios. And fifth, goal setting. Setting a desired rate of returns helps investors establish clear goals for their investments and track progress towards those goals. Then how to calculate rate of return? To find the rate of return, take an investment's current value and subtract the initial value. This will give you either a positive or negative number, depending on whether your investment has gained or lost value. Dividing this number by the investment initial value and multiplying it by 100 will give you a percentage rate of return. And then, why is the rate of return essential? The rate of return is a crucial aspect of investing, as it suggests whether the investment are useful or futile. It also helps in planning future investments accordingly. Rate of return is also called the return on investment and applies to all kinds of investments. Whether we talk about purchasing financial assets like stocks and bonds, real estate assets like sites and houses, or other physical assets like machinery, the concept of calculating returns is relevant. Analyzing the rate of return helps investors make further decisions regarding the dispose of non-productive assets and increasing investments in productive assets. And then, why do manufacturing companies calculate the rate of return? The rate of return can be used to decide whether or not a manufacturing company should continue with a project. If the rate of return is high, for example, the company will make more money than it costs them to complete the project. This is called the profit, and it indicates whether it's worth investing in a particular venture. If, on the other hand, your manufacturing business isn't seeing much profit from its efforts, then continuing with this particular venture may not be sustainable because there isn't much financial benefit at all, or even worse, it has a loss. And then we move to limitations of rate of return. The first doesn't account for risk. A high rate of return doesn't necessarily mean a good investment if it comes with excessive risk. And then, second, doesn't reflect investors' experience. In some cases, the calculated rate of return may not reflect the actual returns experienced by investors due to factors like timing of investments. And then third, time sensitivity. Rate of return can vary significantly depending on the specific time period measured. And fourth, difficulty with irregular investments. It can be challenging to calculate rate of return for investment with irregular contribution patterns. And then we move to types of rates of return. The first, nominal rate of return. The nominal rate of return is the amount generated by an investment before considering taxes, investment fees, and inflation. It enables investors to compare an investment's performance irrespective of the expenses it incurs. Like other rates, it's typically in percentages and may have a positive, negative, or zero value. And then second, internal rate of return. The internal rate of return is a metric for estimating the profitability of potential investments. It is the annual growth rate that you can expect an investment to generate. The internal rate of return can help you analyze capital project and compare potential annual rates over a specific period. The interest rate makes the current worth of all cash flows equal to zero. And then third, required rate of return. The required rate of return is the minimum profit an investor can receive for investing in securities such as stocks. This matrix helps calculate how profitable a project might be relative to the cost of it. The required rate of return also indicates the risk or opportunity involved in committing to an investment or project. It doesn't consider inflation and can vary among individuals depending on the risk they can accept. Calculating the required rate of return often involves examining economic factors. And fourth, annualized rate of return. The annualized rate of return is the equivalent mortgage and or loans an investor receives over a period of time. Many companies call this metric the compound growth value, and it is different from investment annual performance, which can vary depending on the year. And then we move to challenges while calculating the rate of return. The first challenge, accounting for inflation. One key challenge in calculating the rate of return is ignoring the impact of inflation. Inflation erodes the real value of money over time, meaning that nominal returns might not reflect the true growth in purchasing power. If inflation is not considered, the calculated return may seem higher, giving a false impression of profitability. And then second, inconsistent benchmark. Different industries and asset classes use various benchmarks to evaluate performance, making it difficult to assess whether a rate of return is competitive. Without a standard measure, comparing returns across sectors or investment types can lead to inconsistent conditions and conclusion about the effectiveness of the investment. I think it is enough. Thanks for watching.